Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, I just wanted to spend a few minutes giving a quick update to the PCC, which is the put to call ratio, and also we're going to have a little look at the VIX. Now it's been a while, at least a month I think, maybe longer, since we've looked at the PCC. And we took note last time that we'd had a crossover of the short-term over the long-term moving averages from extreme conditions, and we're continuing to move higher. Well, it's the same story. We are continuing to move higher. The stock market is currently in a correction. When I last discussed this over a month or so ago, I suggested that the bottoming out here and the crossover back in July that we had was an early indicator, a leading indicator that trouble was on the horizon and the correction was on its way. It has taken a significant amount of time to actually get here though, but this has been heading higher the whole time, so it is definitely an early indicator, but it can be very early in the case of the crossover we got here back in July, but it was starting to show that there was trouble brewing. Now if you don't understand what I'm talking about, let me just, and you're new to the channel and you haven't seen this graph before, let me just explain what you're looking at here. I've taken the PCC ticker, which is the put to call ratio, and I've simply switched off the price action because it looks like this. Okay, and I've replaced it essentially with a pair of moving averages. So a green one and an orange one. The green one is a 250 day and the orange one is a 60 day. They're both exponential moving averages. And then what I've done is I've essentially taken two lines where I can see the peaks of the put the call ratio frequently coming up to these levels, and I can see the lows frequently coming to these levels. So these are like the extreme bounds. We also have an inner bound where we can see frequent highs and frequent lows touching upon these areas of resistance and support quite frequently as well. So I've basically just tried to average it out and create a range to contain these two moving averages. We came down to levels we've never seen before, in terms of greed and complacency. I think this just makes sense, over time, with the monetary policy of the United States, the attitude of, we're just not going to let the stock market fail under any circumstances. Retail money coming in force into the market obviously has led to a greater level of complacency and ignorance and greed. People simply can't imagine something happening which they haven't witnessed before, and I think that's very much the case with a lot of new retail traders. They don't appreciate that eventually the market will lose half its value minimum, I think. I don't think we're there yet. I have my own count in the S&P, my own count in the Dow. The Nasdaq suggests we still have some time to go until the market peaks, but I do believe it will come. I believe this may be an early warning sign here. This move off of the lows here and this crossover of the 60 over the 250 could be a sign of things to come. We're already into a market correction, but this crossover occurred back in July, middle of July, and we didn't start the correction until September. So it was very much a leading indicator in that sense, as I pointed out at the time. But since then we have continued to head higher, so it's just something to be aware of. If this situation continues to increase, or these averages continue to head higher, and fear starts to grow and really start to gain traction in the stock market, then perhaps the current correction is a little bit more severe than what I've suggested. Now I can't be certain, but I think that's not going to be the case. I think we're going to cool off in a bit, meander around for a while before we have a real panic later, which could be months away yet, or maybe even longer. But either way, it's an early warning sign anyway. Now one thing I have noticed on my own little graph here is we do seem to have a trend of a series of lower highs. So the extreme fear and panic of these previous panics have been becoming less over the time. I think this also makes a lot of sense when you consider, like I said, monetary policy, accommodated monetary policy by the Fed, low interest rates, constant QE, huge stimulus we've had recently as well. All of this helping to encourage more and more people into the market and essentially stifle volatility and create a situation where, combined with passive investing, ETF investing, we've just moved gradually over time. This green and red line should probably be angled with the trend rather than statically as I've got them, because over time we've just become more complacent and we've become less fearful. Essentially the extremes are on a downward trend. So if this were to continue over time, then I think a return to trend would be normal. We've done it here, 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 here. So some kind of move back up to this trend would be expected. How we get there will depend very much on the price action in the stock market. Obviously, I think we could come up to here, and then that would be like our wave 4 that we think we're in the SPY and the broader market. We could come up to here, then meander around, come back to test the lows, and then have that move back up to the trend line, which would be the top of the market as and when it comes. I'm not saying it's impossible for something like this to happen again. It could, of course. We could have an extreme panic if, I don't know, there was some kind of absolute financial crisis, some enormous collapse which just caused global panic. But this move here, this was the March 2020 panic. We got this crossover and we just flew back up to the trend line. So try and think of just how much panic and actual fear and actual concern there was in the world at the time of the COVID outbreak. And it didn't even come close to the kind of reading we got in the GFC or even these prior peaks here. So relatively, it wasn't really a panic, and the move thrust down to new lows was phenomenal. And of course, this was all driven by accommodated monetary policy, sustained low interest rates, QE, and of course, massive stimmy checks going out to people and bringing in the retail traders. On a scale that we haven't seen. Well, I don't think we've ever seen. I mean, I don't know how you'd measure it. Maybe 1929 was the last time we saw this kind of public involvement. Some people would say the dot-com bubble, but I don't think it was the same mass involvement, because today, obviously, it's driven by technology, the accessibility of markets via online brokerages, and so on and so forth. So anyway, to sum up, as we've seen these crossovers of the moving averages in the past, we come up to test the long-term average, we pull back, we break through it. We come up to test the average, we pull back, we break through it. We come up to test the average, we fall back, we break through it. And we come up to test the average, we fall back, we break through it. So this is just a pattern which just plays out over and over again. You can have sudden and extreme moves like this one here, and this one here, this one here. Or you can have much more meandering moves over a couple of years or several years like these ones. So we don't know what we're going to get, but we should just be on guard as the months pass by that this could be an early signal. Both moving averages are now trending higher. So we could have a blow off, some kind of panic move on the horizon, or we could just be having some kind of return to trend over the coming year or so. Right, so that's the PCC. Now let's come over and have a look at the VIX. Now we are not getting the same leading indicator here with the VIX. We won't. By the time this thing has given us several months advance that psychological conditions and risk on and off attitude may be starting to adjust, giving us several months in advance warning, the VIX won't really show us anything other than the same usual compression that we see over time. The one thing I have pointed out before with the VIX, and I do think it's a sign of things to come and help support the PCC in our analysis, is that we just have this sequence of higher lows that just keeps forming. We've got this upward trend. So every time we suppress the VIX, every time we get the VIX crushed back down after a spike, like this spike, this spike, this spike, and the recent one back in March 2020. Every time we get this spike, we can't quite compress it as much as we did previously. We keep completing at higher highs, at higher lows. Sorry, so this is an underlying trend that gradually over time there is a greater perceived risk coming into the market over the last few years since 2018 onwards. We have had these sudden bursts of volatility over the last few years, and we do seem to be under a downward trend at the moment, a series of lower highs. So sooner or later this thing's going to break out, but that could be, it could be well out into next year. We don't know. So all we're really looking for here on the VIX are some clues to future momentum. So the first thing I think we can look at is, having had the 60 moving average continue in a downward trend of lower highs and lower lows, we are currently bottoming out and starting to point back up. Now we've pointed up here and we've pointed up here, okay, and we've had this little point up here, but I would argue the only comparable move in the 60 average with this turn up is this one here. This is a trend, like, if you're an Elliotician, you would immediately spot 5 waves in here. I can't say for at all that you could perform Elliott wave on the VIX. I don't think you can. I'm just saying it comes to your eyes as a smaller structure. This is a slightly bigger structure. This is a slightly bigger structure. These are two structures in between them, and it looks a bit like a 5-wave move. But regardless, we are turning back up, and also for the first time since here we had a minor high in the VIX. This is back in February, and also here we turned up with the 250 momentarily back in October of 2020. So perhaps we're just starting to curve up the 250, we're curving up the 60, and maybe we're going to get a crossover. Okay, and we haven't seen a crossover of the 60 over to 250 since the March panic of 2020. That was the last time the 60 crossed back above the 250 and thrusted higher. So, like I mentioned a moment ago with the PCC, I think that with my own count on the SPY, we could be waiting a while longer inside of here until we have some actual kind of real panic and some actual kind of blow off. So for the meantime, all you're really looking for is, do we get this crossover of the moving averages here? Shall we have a look at? I'll tell you what we'll do. We don't normally do this with the VIX. Let's just bring up a MACD for a minute and see what we can see. So what's interesting here, the first thing I would look at, now we're not analysing a usual asset here, we're analysing the VIX, so we've got to be mindful of that, is underneath the series of lows and higher and lower highs, we've had this compression pattern building. Now, I've pointed this out before in the VIX. So we've got this compression of lower highs and higher lows, and that's underlying a series of lower lows and lower highs. So there's, if we were looking at a stock in this way, or we were looking at a crypto or whatever asset in this way, we would say there's an underlying pressure building up underneath this thing, and I think that's true. These compression patterns occur and then we have a pop, so that's something to look for. Let's just switch that off. And yeah, I think that's all I've really got to say about it. Look for a break above this trend. Look for a break out of this downward trend. Look for this series of new higher lows to continue, because previously the trends have matched up on the way down. So we've had this series of lower lows, low, lower low, lower low, lower low, lower low, in junction with the highs. But now we have a series of higher lows and higher highs starting to form. So if we see this trend continue, we get this crossover, this trend line will be in trouble, I think, and it will get tested. Probably we might pull back again and continue the pattern, or we might come back having tested it and finally break through it. Either way, the VIX is telling us the same thing as the PCCs, which is to just be on guard towards a more significant event in the market. So we'll leave it there. Thank you very much for joining me. If you're new to the channel and you've liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below if you want to. Thank you as always to my Patreons. Your support is greatly appreciated. If you're interested in joining, there'll be a link in the description below, and there's also a link to my Twitter feed in the description below as well. Alright guys, take care, and I'll be back with you shortly. All the best. Bye bye.